A trillion-dollar wave of wealth is already moving across generations, and it's rewriting the rules of global finance. Stay with me until the end, because number one reveals a shift no one expected and could alter every market you watch. Imagine a trillion-dollar tide moving from baby boomers to Gen Z in just a few years, reshaping who controls capital worldwide. Researchers estimate that by 2026, roughly $30 trillion will change hands in the United States alone, and similar currents are rippling across Europe and Asia. This influx of younger owners brings different risk appetites, often favoring tech startups, sustainable ventures, and digital assets over traditional blue-chip stocks. Meanwhile, older investors are leaning toward income-generating real estate and fixed-income products to preserve wealth. The net effect is a reallocation of capital that fuels innovation in some sectors while tightening liquidity in others, prompting governments to reconsider tax structures and succession laws. As the balance tips, we'll likely see new market leaders emerge, and legacy industries may need to reinvent themselves to stay relevant.
Surprisingly, the wealth shift is sending shockwaves through real estate markets far beyond the usual buyer-seller dynamics. Around 15% of inherited wealth is funneled directly into property, according to a recent study, creating a surge in demand for both residential and commercial spaces in metropolitan hubs. Younger heirs tend to prefer urban, mixed-use developments and co-living concepts, while older generations often retain suburban estates. This divergence is driving up prices in city centers, prompting developers to prioritize high-density projects and smart home technologies. At the same time, some regions experience a glut of inherited rural properties that sit idle, depressing local markets. Policymakers are watching closely, debating measures such as higher inheritance taxes on real estate to curb speculative bubbles. The resulting reshuffle could reshape urban planning, affect rental affordability, and influence where future economic growth clusters.
According to venture capital reports, the great wealth transfer is fueling a noticeable surge in tech-focused investments among the new generation of heirs. Younger investors, raised on smartphones and cloud services, are allocating a larger slice of their inheritances to AI, fintech, and biotech startups than their predecessors ever did. This trend is not just about chasing high returns. Many see technology as a vehicle for social impact and legacy building. Consequently, we're witnessing a rise in early-stage funding rounds that previously would have been dominated by institutional players. The ripple effect includes accelerated product cycles, more aggressive talent acquisition, and heightened competition for patents. However, the influx of capital also raises concerns about market overheating and valuation bubbles, prompting some analysts to advise tighter due diligence standards. Overall, this tech-centric reallocation is reshaping innovation pipelines and could accelerate the pace at which emerging technologies become mainstream.
Hidden within the wealth handoff is a growing pressure on governments to revisit tax frameworks that were designed for a different era. As estates swell, many jurisdictions are confronting the fiscal impact of larger inheritance and capital gains taxes, especially where thresholds have not kept pace with inflation. Some countries are already proposing progressive estate taxes that could capture a higher share of transferred wealth, while others are offering incentives for charitable giving to mitigate the tax burden. These policy debates are influencing where heirs choose to domicile assets, prompting a subtle migration of wealth to tax-friendly havens. The resulting legislative churn may also spark international coordination efforts, as nations seek to prevent a race-to-the-bottom scenario. In the end, tax reforms driven by the great wealth transfer could reshape public revenues and fund new social programs or infrastructure projects.
Consider how the new custodians of wealth are redefining the purpose of their portfolios. Surveys reveal that a growing proportion of heirs prioritize environmental, social, and governance (ESG) criteria when allocating inherited assets, often viewing sustainability as a core component of their legacy. This shift is prompting asset managers to expand green bond offerings, renewable energy funds, and impact investment vehicles. Companies with strong ESG scores are seeing increased demand, which can translate into lower cost of capital and higher market valuations. Yet, the trend also introduces challenges, such as greenwashing concerns and the need for robust verification standards. As these investors wield significant influence, their preferences are nudging corporations toward cleaner operations, carbon reduction targets, and transparent reporting. The ripple effect may accelerate the transition to a low-carbon economy, while also reshaping the risk-return calculus for traditional sectors.
Few people know that the great wealth transfer is opening new doors for capital to flow into emerging markets. As heirs diversify beyond familiar domestic assets, they are increasingly attracted to high-growth economies in Southeast Asia, Africa, and Latin America, where demographic trends promise expanding consumer bases. Investment firms report a modest but steady rise in foreign direct investment from inherited wealth sources into sectors like fintech, renewable energy, and infrastructure in these regions. This influx can stimulate job creation, technology transfer, and improved public services, potentially narrowing the development gap. However, it also raises questions about market volatility, regulatory environments, and the capacity of local institutions to absorb large capital injections. Policymakers in emerging economies are thus balancing the lure of foreign wealth with safeguards to ensure sustainable, inclusive growth.
Suddenly, philanthropy is taking center stage as heirs seek to cement their names through purposeful giving. Data from charitable registries shows a noticeable uptick in the establishment of family foundations and donor-advised funds linked to recent inheritances. Many of these entities focus on education, health, and climate resilience, reflecting the personal values of the new generation. By channeling wealth into structured giving vehicles, heirs can achieve tax efficiencies while directing resources toward long-term societal impact. This trend also fuels professionalization of the nonprofit sector, as foundations hire dedicated staff, adopt rigorous impact measurement, and collaborate with governments. Critics caution that concentrated philanthropic power can influence public policy, but proponents argue that strategic giving fills gaps left by public funding. Overall, the rise in legacy philanthropy reshapes how wealth contributes to social change.
Now that the wealth pipeline has shifted, consumer behavior is evolving in tandem. Heirs inheriting sizable fortunes often exhibit distinct spending habits, favoring experiential purchases, luxury travel, and high-tech gadgets over traditional durable goods. Market analysts note a surge in demand for premium services such as private aviation, boutique hotels, and bespoke fashion, which in turn drives growth in niche sectors. Simultaneously, digital payment platforms and crypto-based transactions are gaining traction among younger wealth holders, prompting financial institutions to adapt their offerings. These consumption trends can stimulate job creation in hospitality and entertainment, but may also exacerbate income inequality if luxury demand outpaces broader economic benefits. Understanding these patterns helps businesses anticipate market shifts and tailor products to the preferences of the newly affluent.
Experts predict that the redistribution of wealth will subtly reshape labor markets across the globe. As family businesses transition to the next generation, many heirs opt to professionalize operations, bringing in external executives and adopting modern governance structures. This often creates new high-skilled job opportunities in finance, technology, and compliance. Conversely, some heirs choose to liquidate assets, leading to downsizing or restructuring in legacy industries such as manufacturing and retail. The net effect may be a modest increase in demand for talent in emerging sectors, while traditional blue-collar roles face pressure. Additionally, wealth-driven entrepreneurship can spark start-ups that generate fresh employment, especially in fintech and green tech arenas. Policymakers are watching these dynamics closely, considering workforce development programs to align skills with the evolving economic landscape.
Finally, the great wealth transfer is quietly influencing the balance of geopolitical power. Nations with large pools of inheritable assets, such as the United States, Japan, and Germany, find their economic clout reinforced, enabling them to project influence through development aid, strategic investments, and diplomatic initiatives. Meanwhile, countries experiencing outflows of capital may see reduced leverage on the global stage, prompting them to adjust foreign policy priorities. The concentration of wealth also fuels soft power, as affluent families fund cultural institutions, think tanks, and media outlets that shape public discourse. While the full ramifications are still unfolding, analysts suggest that the financial realignment could lead to new alliances, trade patterns, and competition over technology standards. In this way, the movement of wealth becomes a subtle driver of international relations and future global governance.
We've just toured 10 powerful ways the great wealth transfer is rewriting the economic playbook, from new investment hotspots to unexpected policy battles. If you found this journey eye-opening, hit the like button and subscribe so you never miss another deep dive into the forces shaping our world. Which transformation caught you off guard the most? Drop your answer in the comments, and let's keep the conversation rolling. Thanks for watching, and see you in the next list.